Well, I don't know about you guys, but I'm utterly depressed. Should we all go home now? Because that was pretty awful. What I would say to this is that I think your arguments about debt levels, people know it. It's not like it's a new story. I think the story I'm trying to say today is, yes, it's bad out there, but I don't think it's getting worse. I think it's a rate of change argument. I think it's getting better. So, starting off with my title of my presentation today is The Great Rotation. And for any of you who have ever read the FT, you will know that people nowadays are talking about clients, individuals, pension funds, are starting to put money back into the equity market. In January of this year, we saw almost $30 billion flow into equity funds. This is equity, people. This is positive, good stuff, okay? Yes, we've had $410 billion leave equity markets in the last few years. But that we are starting to see at the margin, very slowly, there's some hope. There's a silver lining. It's not all doom and gloom. And yeah, I mean, I can't argue with a lot of what Paul said. I just think things are getting better. So if we just talk about where we're sitting at the moment, in terms of our views on markets, this is an investment clock that we look at in order to make investment decisions. It's based on a Russian mathematician that lived a long, long time ago. And he looked at cycles in markets and he said, yes, you have certain big drivers that drive asset class performance. And if you look in this graph, if I look here on where 3 o'clock would be, that was the year 2000. And until sort of 2013, absolutely, we've seen prices falling, consumer confidence dropping. We've had a banking crisis. You guys know all about 2008. I'm not going to repeat it. And high unemployment. That is where we've been. But it is our view that we are now at 6 o'clock in the clock. And we think actually in the next couple of years, we're going to start seeing employment increasing, confidence increasing on the back of employment. Inflation is coming. And, you know, this debt bubbles that you talk about, the debt deleveraging story, the only way central bankers can get rid of this debt is through inflation. And in that scenario where they desperately, desperately want inflation, do you want to be holding sovereign bonds? And I'm going to show you some graphs to just show you what risk you're taking when you buy these instruments. And in this sort of course of events, we start seeing stocks rise from very low levels. Back in the 1940s to the 1960s, you had sort of 20-year bull market in equities. That is our contention that the next couple of years, this is an equity-orientated environment. You do not want to be in bond markets. Okay, so let's just talk about the picture as we currently see it. You know, I don't think Paul spoke much about central bankers. He talked about the consumer feeling quite depressed. He talked about austerity measures. He talked about debt deleveraging. It's not like central bankers don't know that. They know that the world is going to slow unless they do something big. We've got the Fed increasing liquidity. We've got the Bank of England increasing liquidity. We've got the ECB. And now, as probably most of you in this room are aware, the Bank of Japan is about to do the same thing. Now the fact is, what are central bankers trying to do? They're trying to create growth, because the only way you can ever pay these debts off is if you create growth. How do we create growth? We force investors to move up the risk curve. We force them to go into riskier assets, or so-called riskier assets, equities, corporate bonds, high-yield bonds, emerging market bonds, Asian bonds, property. You're not going to get it through sitting in the bond market. It creates absolutely no growth. And yes, I agree with Paul. It's still very uncertain out there. Growth remains quite precarious. But as I will show you in some graphs, and for what it's worth, I don't agree on his housing stats. I'll give you some graphs on that. Housing in the US is actually picking up very nicely. We're starting to see some very positive returns. And I think the news is not all that bad. It's improving. Surely in the short term, currencies are a problem because central banks around the world want to have cheaper currencies in order to create growth. And the yen at the moment, as you probably all know in this room, has weakened quite precipitously from sort of the 75 levels of last year to current levels of 93. But that will help the Japanese economy because it will help their export markets. So, you know, we think there's some good news out there. And that's for this equity bond debate. I'll show you some slides just illustrating our point. Okay, the Great Rotation. This is what we've seen since 2007. This blue line is money going into bond funds. And what we've seen at the same time has been a fantastic bond rally. Equity, money's been coming out. That picture is well understood. People have panicked and taken their money out of equity markets. And the orange line here is cash funds. But you can see it's very clear. It's been a one-way direction. Put your money into bonds, take your money out of equities. And that's possibly in the right place to be. But going forward, if you continue to put your money into bonds, you're almost guaranteed, the word guaranteed, to lose money. And I call that an asymmetrical bet, because interest rates on bonds are so low that you are paying for it. I mean, all the bad news is in the price, in the sense that how much worse does the world have to get? How much more Japanese do we have to turn for you truly to believe that bond investing will make you money? And this is what you're buying. This is the so-called safe asset. I want to be sick. This is giving you negative returns in inflation-adjusted terms. Any whiff of inflation in the system, and you are guaranteed to lose money in these assets. This is I know the economic situation is bad. I know things are dire out there, but it's in the price. You know, I think we have to divorce economic analysis from asset market returns. Sure, I can paint a bearish picture just as much as Paul can, but the fact is you need to make clients money, and I think if you put into bond investing, you pretty much are going to lose your money, especially if inflation ever picks up. I mean, just to put it in a much more simplistic term, when you used to buy bonds in the good old days, you got some yield off it. Well, look where interest income has gone. Look at the right-hand side. Your interest has risen over the last couple of years, and it's come all the way down. If you're buying bonds today, you truly have to believe in capital returns, because you're not going to make any money on interest. Contrast that with equities, where you've had a nice dividend yield coming through. The so-called story in markets, you're paid to wait, because they're giving you a return on your investment. You're getting no return on your investment if you're buying bonds. The world knows how bad it is, but it's in the price. If that's one message I can get across today. And US housing. Now, I did a presentation yesterday to Australian Commerce Society, and they were talking about Australian housing. I would absolutely agree. I think Australian housing is very expensive. But it's not expensive in the States. This red line is showing the affordability of US housing. Yes, it was at its peaks in 2007. It's come all the way down. It's now extremely affordable to buy property in the US. Thanks largely to 30-year mortgage rates that have come down because the Fed's manipulated interest rates. But the Fed will continue to manipulate interest rates. That's going to continue for quite a while to come, because the Fed understands it needs growth. And where do you get growth from? You get growth from the US housing market. So next on we got, and guess what? Contrary to what you might have heard earlier, US housing is starting to recover. Remax reported sales in December of 2012, the best house price sales they've seen in years. The US consumer is not dead. Contrary to popular opinion, the consumer is very much alive and is spending money again. They're spending money on vehicles, they're spending money on houses. They're coming back to the party. And I just wanted to prove to you in the short term, if you look at this is the money inflows we're starting to see into equity markets in January, the great rotation that I spoke about. People are sick to death of getting no yield on their investments. You cannot retire on cash. Okay, it's actually that simple. You're not going to. If you want to sit in this room and I tell you that a caution investment, sitting in bonds give you negative real returns, sitting in cash, that's the safest place to be. Fair enough, and do that. But I'm telling you that an awful lot of other people out there are starting to say, it's time. We need some yield on our investors. Those baby boomers in the US, they need some returns, and they're not getting it from sovereign bonds and cash. And you know, it's not me just saying this. This is the European story. Do you remember that Paul talked about Draghi and, oh, the debt levels are dreadful, and he hasn't done anything? Fair enough, he hasn't. But what he has done, he's massively reduced risk appetites or increased risk appetites in Europe. This graph that you're seeing here is the all-sector CDS spread in Europe. It's the cost of insuring against a default on European bonds. The pigs, the Portugal, Ireland, Greece, etc. Well, people aren't worried because look at those spreads. They got very worried in July of 2012 and come all the way down since Super Mario came out with his big bazooka. You know, that makes me quite excited. Yes, Europe is slow, but people aren't as fearful. They're not worried about the euro imploding. The so-called, oh well, let me buy German bonds because I'm actually at Deutsche Marks. No one talks about that at the moment. I mean, it was a good story, but it's changed. Fair enough. Okay, and I mean, before I walk in this room and you all think she's barking mad and she's a bull market investor, in the short term, yes, I will admit, shares are looking a bit frothy. This is a number of stocks above their 200-day moving averages. But you know, I have spoken to quite a few people in Asia this week, and by the way, sorry, I think it's the most amazing place. And I want to talk about that in a few seconds, because a lot of the presentations we do about US growth slowing, Europe slowing, etc., Well, I don't see any slowdown here. I mean, I've never seen traffic like this in all my life. You can't move, okay? Somebody is consuming out there. Somebody's working. Somebody's feeling positive, because I'm not seeing negativity. And please, the UK, I go there 3 times a year, and I know a lot of you are probably British, but I think as a nation you like to be depressed, because I've never come across a people that get so utterly depressed about so many things. It's like it's your natural psyche. But you know, if I come to emerging markets, come to South Africa, the sun shines a lot, people feel good about things. You come here, it's not all doom and gloom. People are still waking up in the morning, buying their Colgate toothpaste, they're still going out and buying their McDonald's hamburgers. I'm sorry, that's another one. McDonald's. Well, of course it should have a higher rating than the US government. You know, if you do your analysis of a company, it's got more assets than it's got debt. Well, then that's a bit of credit risk, isn't it? It's not rocket science. You know, if you look at the US, clearly it's a basket case. Rates should be going up. That's what we're arguing. From a credit risk perspective, absolutely. And guess what? If you're holding those bonds, you're losing money. That's how it works. Okay, back to housing, because I think this is the thing I truly feel excited about in the US today. This index you're looking at here peaked in 2005. It's the Home Builders Index in the US. It peaked prior to the market peaking in 2007. We've had a few years of it doing nothing, and suddenly in the last 12 months, if you bought the Home Builders Index in the US, now obviously stocks, forecasts, they look at the future and say, where do they think things are going? You've doubled your money. Now, if it could be a lead indicator on the downside, could it not potentially be a lead indicator on the upside? That things are not terrible, that growth is picking up. It's not all doom and gloom out there. And you know, where do we see opportunities? Well, I have to put this in here because I'm in Asia. But actually, from a PE perspective, a pricing perspective, Asian equities look extremely attractive to us. And if there's one message I'm going to get across today, I think we're all very good at talking economic stories. But equity markets sometimes reflect that in the price. You know, you're not paying ridiculously high PE multiples. If any of you ever do kind of theory on markets, you will discover that high GDP growth rates do not necessarily mean high equity returns. They're not one and the same cousin. They change. It's all to do with where you think inflation's going, where interest rates are going. And central banks have made it very obvious to anyone who will listen, they're going to keep interest rates lower for longer. They're going to keep interest rates as low until employment picks up. They're telling us we're going to throw money at the problem. Well, in that environment, I want to be in equities, give me a bit of a yield, because I know that interest rate in the bank is not going to be there for a very long time to come. I look at Asia, and growth rates here remain very impressive to me. Even Paul earlier said to me, oh yes, you want to be lending in banks in Asia because they make a lot of money, their margins are massive. Well, I want to be in that business. I don't want to be in a business where margins are terrible. I want to be in a business where they're good. I want to be in a business where demand is strong. Look around you. Look where you live. This place is growing. It's not depressing. And another one, the yen. You know, there are ways in markets to make money even when there's bad news. I think this is kind of also the story I want to talk about today. We've been short the yen now since sort of 82. It's now 93. We've made ourselves 12-13% on that trade. Even in a bad market scenario, you can still make money. I think the Japanese this time are quite serious about getting the yen to weaken. And this graph, while it's quite busy, is showing the amount of money, this yellow line, leaving Japan prior to, and I can't pronounce it, you said Abe, Shinzo Abe, before he came into power. He was saying to the guys, we are going to depreciate this currency. We want export growth to come through. We want inflation. And I admittedly agree with Paul completely. If it grows too fast, yes, you might have an inflation problem. I love that nappy thing, by the way. I've got to find out which company that is, because I want to invest in that. That's a growth market. And you see how you can twist this around. Demographics can be good if you're in the right place. Yes, I wouldn't want to be buying that. And yet another thing, your demographic story about the wealth dispersion. Well, clearly the rich are getting richer. Bring it on, I'll buy Richmond. Because there's a luxury goods maker. I want to buy that consumer. You know, of course I'm not going to be buying Walmart. Maybe it scares me a bit too much. Or certainly not going to buy a retail chain in the UK. But when these things get to P's of 4 and 5, well, now we're talking. Because now you're being paid to take the risk. And I think that's what we forget about. We're too busy going, world's ending, it's all so depressing. Well, equity markets sometimes reflect that in the price. You know, follow the money. Why is the euro strong at the moment? Well, despite all the rhetoric, this black line shows the Europeans have actually not been printing money. They've been cutting back on money. But I think if you look at what we've been hearing the last week or so, I think the euro is going to start weakening again. The Europeans can't handle it. They cannot handle their currency going to 140. They need growth. They need export growth. And if you're in Germany, if you're in Germany at the moment, you're not going to stand for it, because when you're competing with Toyota, you need to know that the price of your BMW you can compete with. Okay, admittedly, I'm a BMW fan. I would never buy a Toyota, but the point is, different market. But there's a pricing aspect to these things. And when the yen weakening so much, people will start turning around and say, enough is enough. We need the euro to weaken. And I think you're going to start seeing a lot more comments coming out soon, some more intervention. And I wouldn't be surprised to see the Europeans starting to print money again. Gold. There's always somebody in a room who's got a very strong view on gold. For our basis, what we think is that gold is a currency. Yeah, I think all currencies are getting a race to the bottom. But I'm actually, don't shoot me here, but I'm quite bullish on the dollar. It's very scary when you say that. People think you've gone completely mad. But if you look at their debt problems, and I agree they've got massive debt problems, what people don't talk about is that I think that the US will be energy independent in not that soon, not that far to come. If that changes, your current account deficit in the US massively improves. They're actually exporting oil now for the first time. A lot of things can change very quickly. If this current account deficit in the US is improving, there's less dollars in circulation, and the dollar can be quite a strong currency. In that environment, you don't want to be in gold, because gold is essentially another currency. The dollar's strong, gold tends to weaken. And this chart that I'm showing you here is the ETF holdings of gold. Now, a lot of people have piled into this instrument, but at the margin, we're starting to see them actually starting to fall. People are taking their money out. And, this is another bullish thing for markets. When people are fearful and depressed, they buy gold. Gold is a fear asset. Well, if you're feeling better about life, the VIX index is low, CDS spreads are falling, you don't buy gold. You want to have assets that are giving you some yield. And we've seen it. We're seeing inflows into equity markets and outflows of gold. Whew. Geez, I had to do too much talking. This is... we look at, when we construct portfolios for you, this is not sort of the bull-bear case. When we construct portfolios, we look at the different asset classes within our remit, because we run 5 asset class funds. And we say to ourselves, where do we think returns will be in the future? And where have returns been in the past? And what I want to highlight in this fairly busy chart, the circle bits are where returns have been. Okay, so property historically has given you phenomenal returns the last couple of years. Bonds have given you fantastic returns. But we think if you're going forward in a long-term view, we think bonds will give you negative nominal returns of up to, I think we've said here, 4%, 5%. Conversely, we think equities will give you 9% returns for the next 10 years. So I'm just saying to you, if you want to have a cautious investment, be extremely careful what's in that cautious investment, because I would argue that bonds today are the riskier asset class and are return-free. Be very careful. We know the poor die in economic news out there, but it's in the price. And I'm saying if you buy equities, there's not a lot of good news priced into equity markets. Yes, we've had a bit of a rally, but in a long-term view, I still think the returns will be fantastic. It's incredible. I've spoken to lots of people in Asia the last couple of days, how many people have said to me, oh, my clients are starting to feel a little bit more optimistic. And that's natural. When equity markets go up, people feel a bit more optimistic. But, markets are too expensive. We're going to wait. I go, really? No, we're going to wait. Okay. We're waiting for that pullback. It's going to fall by 10. We're going to get in. Well, generally speaking, my experience of markets, when everyone's waiting for the pullback, it doesn't happen. And maybe we'll get 2 or 3% pullback. Maybe, Berlusconi will actually become Prime Minister in Italy. Terrifying thought. I don't think it will happen. But that'll scare markets. And but markets climb a wall of worry. There's always a good reason not to be in them. There's always a good reason to get dire forecasts. People like to believe the bad news. I don't know what it is about us. But I'm telling you, at the margin, things are getting better. US economic growth is picking up. Asian growth looks fabulous to me. It's not just about the developed markets. And yes, the UK is going to be awful. There's no doubt about it. The housing market there is massively overpriced. You've got a government that's employed far too many people. It's essentially a welfare state. I mean, when you see how much the UK spends on welfare, it's truly terrifying. But you talk about China, it doesn't do that. You talk about 6 dependents in China, because there is no welfare in China. Well, good on them in a lot of ways, because it means that government doesn't have a massive amount of debt to pay back. And these debt levels. Why does no one ever show charts of debt levels to GDP in emerging markets? Why don't we see that in all these graphs? Because they're good. Because you guys can pay your debts back. There are other opportunities in markets. It doesn't just have to be a developed market, looks terrible, and the whole world and write it off. There are other opportunities. We have equity funds that have done like 20-30% for us last year. Insurance funds, Asian financials, Asian consumers. There are lots of other opportunities out there. It doesn't have to be all doom and gloom.
That's me.